Lumentum Holdings, ticker LITE, just delivered a massive top and bottom line beat for their fiscal Q4 2026.
Oh, yeah. An absolute monster of a quarter.
Seriously. So revenue came in at $1.01 billion. That absolutely crushes the $989 million consensus. I mean, we're talking a 109% jump year over year.
Right, completely doubling the business.
Exactly. And non-GAAP earnings per share hit $3.23, which easily beat the $2.97 consensus. So that's up 267% year over year.
It's just massive growth across the board.
Yeah, and the Q1 fiscal 2027 guidance was also a total blowout. Management is forecasting revenue between $1.225 billion and $1.275 billion, and EPS of 4.05 to 4.35 cents. Both of those are just miles ahead of Wall Street estimates.
They really didn't leave any room for doubt there.
You'd think so, right? But imagine putting up those kinds of flawless historic numbers, literally doubling your business in a single year, and then you just watch your stock drop.
Yeah, the market reaction was wild.
Totally. After this kind of muted after-hours session, Lumentum plunged 8.6% in the next regular trading session, settling down around $824 a share.
Which sounds completely counterintuitive until you really look at the valuation context heading into this print.
Right, because context is everything here.
Exactly. I mean, this is a stock that had already rallied roughly 600% over the past year. Lumentum was trading at a trailing price-to-earnings ratio of over 150.
Wow, 150.
Yeah, and when you're invested in a hardware company at a 150 multiple, you're not just pricing in a perfect quarter. You're basically pricing in a flawless future.
So perfection was already the baseline.
100%. Institutional investors looked at this phenomenal beat, recognized that the company cleared an almost impossibly high bar, and systematically just decided to lock in their profits.
Classic sell the news event.
Exactly. At that valuation, literally any hint of friction in the future means severe multiple compression. So they took their money off the table.
So if the market is dumping a stock that just doubled its revenue, we really need to look under the hood for this deep dive and figure out where exactly this $1 billion is coming from.
And if it's actually sustainable.
Right. So Lumentum essentially has two core divisions driving this hypergrowth. You have the components division, which generated $649.4 million this quarter.
Which is huge.
Yeah, that's 64.5% of their total revenue, up 102.7% year over year. And then you have the systems division, bringing in $356.9 million.
Which is the smaller piece of the pie.
Right, making up the remaining 35.5% of revenue. But the thing is, it's growing at an even more incredible 122.6% year over year.
And those two specific divisions, I mean, they're the bottleneck solvers for modern data centers.
Because AI is just breaking traditional setups, right?
Completely breaking them. The raw compute power of artificial intelligence has entirely outpaced traditional networking capabilities. The servers are just too fast for the old pipes.
Right, so let's ditch the old tired analogies of like engines and traffic controllers and look at the physical mechanics of what you are actually investing in here.
I love that. Let's get into the physics.
Yeah, because when we talk about the components divisions, specifically things like their electro-absorption modulated lasers or EMLs, we are talking about pure physics. And EML doesn't just shoot a beam of light.
No, it's way more complex.
It acts as an ultra-high-speed microscopic shutter. It is literally blinking billions of times per second to encode digital data into pulses of light.
Billions of times a second. It's almost hard to conceptualize.
It really is. And then you have the systems division, specifically their optical circuit switches, or OCS. These are micro-electromechanical systems.
Right, the tiny mirrors.
Yes. Think of a tiny room filled with microscopic mirrors that physically tilt to bounce these beams of light into different fiber optic cables.
It's wild because they're routing data across the facility without ever having to slow down and convert that light back into electricity.
Exactly. It stays light the whole time.
Which is the crucial mechanism behind this entire demand cycle. I mean, historically, data centers moved information using electricity over copper cables.
Which worked fine for a long time.
It did. But when you try to push data at the new 800 gigabit or 1.6 terabit speeds that these AI workloads require, pushing electrons through copper just generates an immense amount of heat.
Like a toaster wire.
Basically, yeah. It essentially turns your networking cables into space heaters. And the signal degrades rapidly over very short distances.
So they have to make a switch.
They're in a desperate transition. Hyperscalers are moving to photonics, using light instead of electricity, because it is literally the only physical way to move data fast enough without melting the data center.
Without burning the whole place down.
Exactly.
And the numbers completely back up that desperation. I mean, the broader optical transceiver market is projected to hit $39 billion by 2026.
Which is a massive TAM.
Huge. Hyperscalers are essentially buying up Lumentum's EMLs and optical switches as fast as they can come off the fabrication line.
Every single one they can get their hands on.
But selling hardware at light speed is only half the battle. Did they actually make money on this billion-dollar quarter?
Operationally, yes.
Yeah.
And highly efficiently, actually.
Yeah, their operational efficiency looks phenomenal. Non-GAAP gross margins expanded to 50.4%, which is up from 37.8% a year ago.
That's a massive leap in gross margin.
It is. And operating margins hit 36.6%. But, and this is the massive $7.2 billion elephant in the room that we really need to address.
Oh, yeah. The JAP number.
Right. If you are skimming the headline numbers on your brokerage app right now, you are going to see a glaring contradiction.
It looks like a typo, honestly.
It really does. How does the company double its revenue, expand gross margins past 50%, and still report a staggering $7.2 billion GAAP net loss?
It's brutal to look at.
It equates to a loss of $84.65 per share on a GAAP basis. I mean, that is just wild.
It is a totally jarring number to see on a balance sheet.
Yeah.
But this highlights exactly why you have to understand corporate finance mechanics.
Right, because this wasn't cash flying out the door.
Exactly. This was absolutely not an operational cash burn. That $7.2 billion GAAP net loss was driven by a one-time, non-cash $7.8 billion debt extinguishment charge.
Okay, let's unpack that for a second.
So Lumentum actively chose to restructure their debt by equitizing major portions of their 2026, 2028, and 2029 convertible notes.
Let's break down exactly why management would choose to do that right now. Because when a company issues convertible notes, they're basically borrowing money with an agreement that the lender can eventually convert that debt into shares of the company's stock.
Exactly. It's a loan that turns into equity. And because Lumentum stock has surged 600% over the past year, their equity has become this incredibly valuable currency.
Like printing their own high-value money.
Basically, yeah. Management looked at their balance sheet and realized they could wipe out massive future cash obligations by letting those note holders just convert to equity right now.
But because of the accounting rules, it looks terrible on paper.
Right. Under GAAP accounting rules, because the stock price is so much higher now than when the debt was actually issued, handing over those highly valued shares gets recorded as a massive paper loss.
But no cash actually left?
None. The reality is that no actual cash left the building to pay off that debt. In fact, if you check their liquidity, they're sitting on $2.7 billion in cash, cash equivalents, and short-term investments.
So the balance sheet is technically fortress-like.
Extremely solid.
But if you are holding this stock in your portfolio, converting debt to equity has real-world consequences for your position. We need to talk about share dilution.
You really cannot ignore the dilution here.
Right. Because of that strategic equitization, Lumentum's diluted share count has swelled to roughly 102 million shares.
Which changes the math on everything.
It does. Think of your earnings per share like water pressure in a hose. If you have a set amount of water representing the company's net income flowing through that hose, the pressure is strong.
Right.
But if you suddenly poke 20 million new holes in that hose, which is essentially what issuing all those new shares does, the pressure at any single hole drops dramatically.
That's a great way to picture it.
Even if Lumentum doubles the total amount of water flowing through the system next year, the pressure per hole might barely increase because it's being distributed across so many more exits.
Yep, the pie is just sliced a lot thinner.
Exactly. Lumentum's absolute net income now has to grow exponentially just to maintain attractive per-share metrics for investors.
Which perfectly sets up the forward-looking narrative.
Yeah.
I mean, if the current investor base is diluted, management has to drastically expand the total addressable market to compensate.
They need a much bigger hose.
Precisely. And on the earnings call, CEO Michael Hurlston gave us the roadmap for how they plan to do exactly that.
Right. Hurlston noted they are reaching their target financial operating models more than a full quarter ahead of schedule.
Which is pretty rare in hardware.
Very rare. And the specific catalysts he highlighted were ultra-high-power co-packaged optics, or CPO lasers, and initial orders for external laser source modules, or ELS.
And these are the technologies that fundamentally shift Lumentum from just a networking company to a core compute infrastructure company.
So how does co-packaged optics actually work in the real world?
Well, historically, optical transceivers, the modules that turn electricity into light, they were plugged into the front panel of a server rack.
Okay.
So the data had to travel from the GPU all the way across a printed circuit board via copper traces to get to the front panel and only then get converted to light.
And as we established earlier, pushing data through copper, even for just a few feet inside the server rack, is now creating a latency and thermal nightmare.
It's totally bottlenecking the GPUs. So co-packaged optics solves this by taking the laser and the optical modulator and manufacturing them onto the exact same silicon substrate as the GPU itself.
Wait, right on the chip.
Right next to it. You're moving the light conversion directly next to the brain doing the math. So the distance the data has to travel over copper drops from meters to millimeters.
Oh, wow. That's a massive difference.
It drastically slashes power consumption and heat generation. It's a game changer.
And what about the external laser source modules, the ELS?
So lasers naturally generate their own heat, right? And sometimes you really don't want a hot laser sitting millimeters away from a $40,000 GPU that is already running incredibly hot.
Right, that sounds like a recipe for a meltdown.
Exactly. So an external laser source allows you to keep the actual light-generating laser outside the immediate chip area. You pipe the raw light into the chip via a fiber, almost like a power cord.
Okay, that makes sense.
And the modulator sitting next to the GPU just acts as the shutter, encoding the data without the thermal burden of housing the laser itself.
This physical evolution of the data center is a massive financial catalyst. I mean, management is projecting that co-packaged optics alone represents a $5 billion incremental revenue driver.
It's huge.
By penetrating in-rack connectivity, replacing copper, deep inside the server Lumentum is massively expanding its total addressable market.
And you cannot discuss that TAM expansion without bringing up the apex predator of the AI ecosystem. Yep. NVIDIA recently committed to a $2 billion investment to build out U.S. photonics research alongside Lumentum and its primary rival, Coherent.
And we should be clear, that isn't just a generic research grant.
No, absolutely not.
NVIDIA is aggressively securing its own supply chain. When the company designing the AI chips is directly funding the development of the optics that will connect those chips, they are cementing Lumentum as critical, non-replaceable infrastructure.
It creates a captive ecosystem. NVIDIA needs these in-rack optical solutions to ensure their next-generation GPUs aren't bottlenecked by slow data transfer.
They can't afford to have their GPUs sitting idle waiting for data.
Exactly. By funding Lumentum, they gain unparalleled demand visibility, and Lumentum gets a practically guaranteed buyer for their next-generation tech.
Okay, so the demand is completely structural. Management is beating targets early, margins are sitting at 50%, and NVIDIA is literally bankrolling their R&D.
Sounds perfect, right?
Right. So let's play devil's advocate. Why the caution? Let's dissect the specific risks threatening this bull thesis, starting with the insider transactions.
This is where it gets interesting.
We've seen 22 recent insider transactions at Lumentum, and the net direction has been heavy selling. If the future is this bright, why are insiders dumping shares?
Because insiders are acutely aware of their own operational limits. They know that at a 150 PE ratio, Wall Street expects limitless growth.
Right, but hardware doesn't work like software.
Exactly. Manufacturing physical hardware is strictly bound by reality. It takes time, space, and materials.
Which brings us to capacity gate. CEO Hurlston flat out admitted on the call that their EML supply-demand imbalance is greater than 30%.
That's a huge gap.
It is. They are, in his exact words, significantly undershipping demand on pump lasers. And a massive piece of their expansion plan, this key new manufacturing facility in Greensboro, it won't be fully online until 2028.
3 to 4 years away.
Yeah. They are effectively sold out, but they physically cannot build the parts fast enough to capture the demand sitting right in front of them.
And this capacity constraint collides violently with a major policy catalyst unfolding in Washington right now.
The FCC rules.
Right? The FCC is reportedly drafting rules that would explicitly ban U.S. data centers from using new Chinese optical transceivers.
Oh, that's a big deal.
Massive. This is direct regulatory target on companies like Zhongji Inolite, which currently holds a massive 27% share of the global data center market.
Wow, 27%.
Yeah. When news of this potential ban broke, Lumentum stock actually jumped 6% in a single day.
Right, because the market assumes that shutting out a Chinese supplier with a 27% market share will just force U.S. cloud operators to instantly buy domestic.
Exactly. The knee-jerk reaction is that all that revenue goes straight to Lumentum.
But here is where I want to push back aggressively on that bullish policy narrative for a second, because the math just doesn't add up for Lumentum in the short term.
Let's hear it.
If management is openly telling us that they are already under shipping demand, right, that their supply deficit is over 30%, and they are severely constrained until Greensboro opens in 2028, How does a ban on Chinese competitors actually benefit them right now?
That is the million-dollar question.
I mean, if U.S. hyperscalers suddenly can't buy from InnoLight, they are absolutely going to knock on Lumentum's door. But Lumentum doesn't have the capacity to fill those orders. Doesn't this just create a catastrophic industry-wide bottleneck that Lumentum can't physically monetize for another 2 to 3 years?
You've hit on the exact logical friction point of this entire earnings report. And honestly, this is exactly why institutional money took their profits and stepped back.
Because it's a huge risk.
A policy ban is theoretically a massive long-term tailwind. But practically, in the immediate future, it actually exacerbates Lumentum's ultimate risk.
Sure.
Their primary risk is no longer a question of capturing demand. It is a question of pure manufacturing execution.
Even if they're handed a captive market by the FCC, they still have to physically build the lasers.
Right. And they have to yield high-quality lasers at massive scale without compressing those beautiful 50% gross margins.
Which is not easy to do when you're rushing.
Not at all. If they fail to scale production quickly, they leave billions of dollars on the table over the next 4 quarters. If the SCC effectively bans 27% of the global supply chain and domestic producers like Lumentum and Coherent cannot fill the vacuum, well, hyperscalers might actually be forced to delay their AI cluster buildouts simply because they cannot procure the optical switches needed to connect the GPUs.
Wow, so it stalls the whole AI build-out.
Potentially, yeah. The demand is structurally there. The policy might force even more demand their way. But if you cannot build the hardware, you cannot recognize the revenue.
It's an incredibly high-class problem to have, honestly, literally having too much demand. But it is still a physical limitation that can severely punish a stock trading at perfection multiples.
Exactly. Which brings us to the macro concept that you really need to ponder if you are holding or thinking of holding any stock in this sector.
And what's that?
Well, people love to call companies like Lumentum a picks and shovels play for the AI gold rush. But a more accurate way to look at it is that they're laying the fiber optic circulatory system for the AI brain.
I like that. They're the pipeline builders.
They are. But pipeline builders only thrive as long as the empire keeps expanding. Moving forward, the most important metric for you to monitor isn't actually Lumentum's own quarterly earnings reports.
You have to watch the hyperscalers.
You have to watch the CapEx guidance from Google, Meta, Amazon, and Microsoft.
The ones actually writing the checks.
Exactly. If those 4 cloud giants ever signal even a slight pause in their AI infrastructure spending, or, if they delay build-outs because of supply chain bottlenecks, the optical suppliers trading at triple-digit multiples will be the very first to suffer the whiplash. Lumentum's flawless execution only matters if the titans of tech keep signing the checks.
You are constantly balancing the reality of a multi-billion-dollar optical transition against the physical friction of manufacturing. Remember to follow the show for daily, no-fluff recaps of the market's most important earnings reports.